Hey guys, welcome back to the channel. Today I'll be showing you guys how to backtest a cash covered put strategy. Now I am going to be using my database, and all the options data is directly from the CBOE, and the backtest will only include monthly expirations starting from April 16th, 2021 until present. So I'll be backtesting a couple of tickers and I'll show you guys the performance for each of them. So we're going to go ahead and start off by requiring a couple of packages. I'm going to assign my database password and store it into this new environment. You will just need to replace this with your current database password. So once that's assigned, I'm going to go ahead and create a sequence of dates starting from April 16th. That's when I started scraping CBOE data. So we're going to sell puts on Friday expiration for the following month and just hold until expiration. So I'm adding 30 days to the current date, so that'll give us the very next expiration. So I'll go ahead and run this line. So now that we have a date sequence, I need to extract the actual expiration dates. So that's what these two lines are doing. So that gives us 9 expirations from April 16th until present. So now I need to create a function so that I can require options data from my database. So that'll be this following function where we just pass in the ticker, the opening date, and the next expiration date. So the opening date will be the Friday expiration of whatever current month we're in, and the next expiry will just be the following month's expiration. So that'll give us about a month of time decay, hopefully. So if we open up this function, I just need to create a connection to my SQL database, and this is the query I run. So I'll pass in my connection, and I'm selecting all from my CBOE options where the symbol matches the ticker I pass in, and the date or the current date is the opening date, and the expiration will be the following month, and the flag will be P for puts. After I get that data, I'm just going to disconnect and return the options. So that's what this function is doing. So we'll go ahead and minimize this and run it. So for the actual covered put strategy, we need another function, and for the parameters, I'm just going to pass in the vector of expiration dates, which we calculated here, the symbol that we want to do a backtest on, and how many strikes below the at the money we want to sell. So if we choose 0, we will sell the very first put that's in the money. Otherwise, you can choose how many strikes you want to sell below that very first in the money put option. So if you select 1, it'll sell the very first put that's out of the money. So I'm going to go ahead and open up this function. Alright, so the first thing that this function will do is it'll grab the expiration dates, and for the length of those expiration dates, we're going to go ahead and apply a function. So the opening date is when we sell our put, and the next expiration will be the following month. So as an example, the opening date will be November 19th, 2021, and we're only selecting those options that expire December 17th. So that'll give us about 30 days until expiration. I'm going to go ahead and read in the options from my database by passing in the ticker, the opening date, and the next expiry. Once we read in the options, I need to calculate the difference between the stock price and the strike so that I can tell which strike is closer to the actual stock price. So once we assign that, depending on what the user enters here as strikes below at the money. So if the user chooses 0, I'm going to eliminate all the out of the money calls, which can be represented by all those that have a difference between the stock price to the strike greater than 0. So once we narrow down our list, I'm going to select which one has the least difference by running the following line. Otherwise, if the user chooses something different than 0, I will go ahead and first compare if the range that the user entered is greater than what's available. And if that's the case, it'll only choose the very last out of the money put. Otherwise, if it's within the range, I'm going to subset only the out of the money puts and sort lowest to highest, and then select the put by the number of strikes that are out of the money. So if you choose 1, it'll select the very first one that's out of the money, and so on. Once we have our options subset, I only want to extract a certain amount of columns, which will be the date, the expiration, the number of days to expiration, where the stock closed that day, the strike price, and the mid price of the put option. And here I'm just reformatting the column names, and then finally just return that data frame. So it'll do that for all the expirations. So I'm going to go ahead and minimize this. Once we get that list, I'm going to go ahead and rbind all the options. So this will return a nice data frame. I'm going to go ahead and add the latest quote for the very last expiration since it hasn't expired yet. This will give us a good approximation of where things are headed. I'll go ahead and add the underlying price at expiration for all of my options. After I add that, I'm going to calculate the net premium received. So this will be the difference between what we collected as a premium versus the underlying price at expiration. And this will be useful to calculate our net P&L, which is the next line. So if the underlying closes above our strike price, then our put will be left out of the money. Therefore, we can collect all the put premium, which is what this is testing. So if the difference is positive, then we collect all the premium. Otherwise, if it's in the money, then I need to calculate the put premium plus the difference between the strike price and the underlying price. And I'll go over this once we run this function. So that'll give us our net premium. The next thing I want to do is calculate the returns for both the strategy and the stock. So for the strategy, it'll be the net premium divided by the strike price. And for the stock, it'll just be the price at expiration divided by the opening stock price. And then finally, just return that data frame. So I'm going to go ahead and minimize this function. I'll go ahead and run it. So as an example, I'll go ahead and run this for the SPY ETF. And I'm going to sell the very first put that is in the money. So I'll go ahead and run that. All right, so if we take a look at that data frame, so here we have our opening dates, the expiration date, the dates to expiration for each of the months, the opening stock price, the strike we sold, the put premium, the price at expiration. The stock to strike is just the difference between the strike and the price at expiration. So here for this very first case, since we sold our put at the 418 strike, we lost $3 since the price at expiration is 414.98. So if the stock declines and our strike is in the money, we need to buy the stock at the strike. So since we are buying at 418 and the current market price is approximately 415, we lost $3.02. But since we received the put premium of 712, then our net premium becomes 410, which is just the stock to strike plus the put premium. And that's only if the stock declines. If the stock rises, such as in this case here, it looks like the stock rallied 16 points. So it went from 414.90 to 431.41, and we sold the 415 strike. So our put option was actually left out of the money, therefore we collected the full 721. So that's what these columns are calculating. So it looks like on a net basis, we are currently at a loss at this month. All other times we seem to have been on the positive side. And if we scroll to the right, the last two columns are just the returns for the strategy and for the stock. So it looks like for the SPY ETF, we can collect approximately 1% to 2% using the strategy. So in this very last case, it looks like we sold the 469 strike when the stock was trading around 468.86. We collected 752. The most current price, since this hasn't expired yet, is 453. So the underlying lost 15.5 points. But since we collected 752 in premium, we only lose 806. So that's why our loss is a little bit lower than the actual market loss. So for the strategy, we only want the loss to be minimal, or we want the stock to rise above our strike so that it's left out of the money and expires worthless. So now let's take a look at the returns if we choose to sell the very first put that is out of the money. So if we go back to our script and run this following line, and we take a look at that data frame. So everything's the same up to the strike. So if we take a look at our first case, we sold the 417. That should be the first put out of the money. And if we double check with our other data frame, so we sold the 418. Now we're selling the 417. So we receive a little bit less of premium. The price at expiration remains the same. The stock to strike will differ a little bit since we're using different strike prices. But overall, by looking at the return of the strategy, it seems to be consistent of staying between 1 and 2%. So these were our checks to make sure everything is, for the most part, accurate. I'm going to go ahead and close these data frames out. All right, so now I wanted to test a couple of tickers, and the ones I will be testing will be Apple, our Spiders ETF, Ford, eBay, the Qs, and Tesla. So I'm going to go ahead and run this. I'm going to go ahead and apply the strategy. In the next video, I'll go ahead and test stocks that trade between $10 and $30. And I'm also going to show you how I screen these and how to send them to your brokerage. But that'll be in the next video. So that's why this is blocked out. So to get the back test, I'm going to go ahead and lapply, pass in the tickers as a list. So the very first thing it'll do is print the current stock. And this is just in case it breaks, I know which ticker got an error, and this will be printed out in your console. I will pass in the ticker into our function along with the dates, and the strikes below at the money will just be 0. So if we didn't get an error, I'm going to calculate some stats so that we can compare these by ticker. So I'm going to combine the ticker name, I'm going to combine the sum of the stock to the strike. So this sums the difference between the stock price at expiration to the strike, along with the sum of the put premium, the net premium, and a couple of averages. So it'll include the average stock price throughout, along with the strategy return and the stock return. I'm also going to sum the strategy return along with the stock return over the backtest, the number of months this strategy was backtested, the number of losing months, the number of winning months gross, and the number of winning months net, and then finally the net winning percentage. And I'm going to return everything as a data frame. After that is combined, I'm going to format the column names, and I'm also going to be adding the strategy Sharpe ratio along with the stock Sharpe ratio. And then finally just return that data frame. So if we scroll up and minimize this. So once you run this block, it'll return a list, which we then need to rbind to get a nice data frame. And I'm not going to be running this just to save some time, but if we load this up into our global environment and we take a look at res, so here we have our 6 tickers, the number of market points. Preferably we want this to be positive because we want the stock to rise so that we collect all the put premium. The next couple of columns are just the gross premium and the net premium, the average stock price throughout the backtest, the average strategy return. So it looks like the highest was probably Ford, the average stock return each month, the total strategy return, the buy and hold return, the number of months in the backtest. So I was able to get all 8 for all of these, the number of losing months, the number of gaining months, the net gains. So for net gains, even though we lost some months, it didn't lose far past our break even, therefore it was considered a net gain. And we also have our percentage wins according to the net, our strategy Sharpe ratio, along with the underlying stock Sharpe ratio. So it looks like we get okay Sharpe ratios for the strategy, but I would like to test more tickers and see if we can get something a little bit higher. So that's what I'll be covering in our next video, along with how to send these orders to interactive brokers. So stay tuned for that. And this concludes the video, guys. I really hope this was informative. I'll go ahead and put a link down in the description area where you can get this script. Thank you so much for watching. Please subscribe to the channel if you haven't done so already, and I'll see you guys in the next video.